Welcome to the Unconventional Investor Podcast. I'm your host, Michelle Moses, certified financial planner, licensed realtor, and founder of Me Financial. If you're an accredited investor feeling overwhelmed by managing your portfolio and looking for alternative investment strategies that go beyond the traditional stock market, you're in the right place. Let's head into today's episode so you can start taking control of your financial future. Hello, everyone, and thank you so much for tuning in. Today, we are going to be talking about an oil and gas investment from Trellis Energy. They have a private placement that we are going to be talking about. And to talk about that, I have Braden Hudson here. You want to say hi, Braden?
Hi, everyone. Thanks for having me. Thanks, Michelle, for setting this up. Look forward to the chat.
Yeah, me too. So Braden is a licensed CPA and has over 13 years of oil and gas experience. He is a Hart Energy 40 Under 40 award recipient, and he is the co-founder and CFO of Trellis Energy. And thank you so much again for being on. All right, so let's get started here. I want to talk about so we met at a conference, and I have been reviewing Trellis Energy's all of their documents and due diligence reports and everything. And I thought it would be nice to have them on because in the oil and gas sphere, there are a lot of the tried and true guys that have been around for years and years, and they are kind of structured in a certain way. And Trellis seems to be trying to do something different, which is why I wanted to have you on. So would you like to give us a overview of what your private placement is and what you're raising money for?
Sure. So Trellis Energy, as you mentioned, is in the oil and gas space. So we predominantly focus in the upstream, which is just the development of oil and gas wells, actually drilling and completing, fracking, all those terms that y'all have heard. But we do it from just a slightly different perspective in the sense of we're a non-operated oil and gas sponsor. And so we don't actually, we're not the ones out there actually drilling the wells, scheduling time and employees, et cetera. We don't have all the field ops. Effectively, what we're doing is taking a fractional ownership in each of these development projects. We do that across really any and all areas across the U.S. We haven't touched international development yet, but I don't suppose that won't happen someday. But what that does is really we're a growth platform, so we're looking to recycle cash flows from projects as they come in. So we'll deploy capital over 2 to 3 years. It'll be all focused on, or I guess spent over, probably 15 to 20 different projects. That'll be spread across the U.S. That'll be spread across different commodities. It'll be spread across different operators and ultimately different areas. And so what that does is provides a diversified platform. So our goal really, we're not going to have maybe the huge 10x types results that maybe some of these other people try to tout. What we're really looking to do is limit the downside and control the environment. So that way, especially in this space, for individual investors, that we're actually providing a capital appreciation to them, even in kind of market such as today, maybe that's a little volatile. And so we're looking to raise $25 million, minimum investments, $50,000. We are a 506C, so accredited investors only, but that allows us really to talk to anybody and everybody. And then, as I mentioned, we're looking to, capital be deployed over the first 2 to 3 years. So we are a growth platform. Most projects in oil and gas pay out in less than probably 2 to 3 years. And so we're looking for projects that pay out in less than 18 months. So that way we can start recycling cash flows and provide that growth platform for your clients and other clients out there.
And in your fund that you're talking about recycling cash, when do you decide to stop recycling it and then give it back to the investors? Is there any sort of test that you have, or is it just going to be time?
It's not necessarily a quantitative test or anything specific per se. We do have written into the PPM that we will start making distributions after year 3 at a minimum. And so it's possible we start making distributions sooner than that. But it's all going to be based on kind of current market environment, that's both M&A dynamics, both just kind of general market sentiment, et cetera. And so, depending on how the fund's going depending on the type of really project flow that's coming at us. And so if it's kind of maybe a dead time, then maybe that's probably the right time. The other side of that too is the exit. And so we are looking to exit these assets over the course of probably year 4 to 7 is ideal. And so again, everything I just said on kind of from a buying perspective is flipped to the other side on a sell side. And so if we get to year 4, maybe we stopped recycling projects because it's the right time to sell and exit the investment. So both of those things kind of are running in tandem, and we're looking at the market to make sure that we're hitting both of those at the right time.
And would you be able to sell? So you're invested in a well. I mean, is that what I should just say? Okay, so you're just invested in this well, and it is producing. And could you exit it? Are you saying you would exit it by selling it to someone else, or that the operator would let you out? Like, how would you exit?
Yeah, so predominantly it would be a sale, and so we have several different groups out there. I mean, in the public space, you've got groups like Northern Oil and Gas, or NOG. There's the TESS. There's also a bigger group called RISA, and so these are big multi-billion-dollar enterprises that are looking for larger packages. And so what we're doing is we're taking kind of some of these smaller projects that are anywhere from $500,000 to $5 million at any given space, and aggregating that to a point to where hopefully it's worth, maybe 9 figures or more, et cetera. And so then that all of a sudden those players start to come into play.
And so then you would sell it all as one, is kind of what you're thinking. Okay.
Yeah. The idea would be to sell it all as one, although we've, in prior iterations of this and things that's been outside of kind of this fundraising environment within, RAs and individual broker dealers, is we've sold it in multiple tranches. So again, looking at who's the buyer set, what are the market dynamics? That could be regional, that could be United States, it could be geopolitical, right? And so there's just so many different factors that come into that we're constantly evaluating, so that way we don't miss in a certain time frame.
Mm-hmm. And so when you're talking, you did touch upon this about the 500,000 to 5 million. Is that why you have this sweet spot and why you're starting this fund, is because you are able to deploy capital in those increments and other people don't even want to look at those deals?
That's correct. I mean, there is a large set of non-operated players. It's become more competitive. I like to think that my co-founder, Jake Bailey, kind of started the movement back in 2017, 2018, and then you've seen a lot more activity in this space. But what you're going to find is, as any industry, the more longstanding relationships, the more times you can, treat people right and be effective in closing assets, selling assets, et cetera, stuff like that. That those would be the groups that withstand kind of any sort of competitive dynamics within kind of people entering the space. But yeah, so there is a market for $100 million deals. You got some of those that are looking at $1 billion deals, and then you've got, like I said, some very small. And so we fit into a space where you've got groups. In fact, we just closed a deal into this fund, I guess it's been 2 months ago now, where as an individual who was being asked, there's some new wells, was being asked to fund roughly $5 million of capital. This is an individual. I don't know how many individuals out there necessarily have $5 million just sitting on the side waiting to put into projects, but this particular individual didn't. And so we stepped in, purchased those assets, and now we're going to participate in that $5 million going forward. And so you have a lot of that, where on the smaller scale, you start to get into smaller groups who are saying, yeah, we play in the $100 to $1 million space. We play in the $1 million to $10 million space. We play in the 50 to 150 million. And you just kind of got these different chunks. And so we're kind of sort of on the smaller end. And like you said, I do think that allows us to fit a niche that, there are other players, but I think that we do pretty successfully.
Okay. And then could you go more into explaining what you said non-owner operator, am I using the right terms? That means to just like a regular person? Is there a way to explain that so that they could understand it, or make it like something else. Do what am I trying to say? Make it the same as like a story.
Right. Yeah. So I think it's sort of similar and maybe think of it as like a real estate. Somebody buys a building. More often than not, that individual is not going to actually run the building, but sometimes they do. So sometimes you got an individual who buys a building, leases it out, manages it, does all the maintenance, et cetera. Of course, that individual may not be able to purchase the whole building, and so they look for other investors to kind of come alongside them. And so that's where we fit. We're just taking fractional ownership, and then they are the ones effectively buying the building. We're taking partial ownership of that, and then they're the ones, being the property managers and taking care of all the decisions and all the maintenance, and of course the drilling and completions up front, but then everything thereafter. So we're literally, the hardest thing we do is get a check in the mail and make sure it's classified the right way, and get a invoice in the mail and make sure it's put in the right spot. Of course, there's certain things that we do within that communications with those people who are managing the properties, making sure they're doing it right. There's a lot of forecasting and kind of backward looking cash flow analysis to make sure that we're getting charged appropriately and they're running the assets appropriately. But effectively, they are in charge.
Okay. And so obviously then you are investing with operators that you have a history with. We kind of already covered this. And so you trust them, or, you're wanting to really get into that area, or it's just, a sound investment. And so is there a goal for how many different investments that you're going for in this fund? Like what's your forecast with that?
Yeah, so it's hard to pin it down exactly, but like I said, we're raising $25 million, and because of the recycled cash flows, it probably means we're going to spend somewhere between $40 to $50 million of capital dollars, capex, which, again, if you go back to kind of the 500,000 to 5 million, probably means we're going to be doing somewhere between 15 to 20 individual projects. And one thing I want to touch on, you kind of mentioned it a little bit just briefly there, was, we are looking to participate behind or alongside operators who really know what they're doing. And so, EOG, Chevron, Oxy, some big names out in the public space and in the private space. And we always joke that we do a lot of our analysis based on closology and not geology. So we look at wells that are right around, we look at the operator in that area. And if we get too far down the rabbit hole of trying to make sure that the geologic formation works versus the success rates around the area, then we've gotten probably too risky. And so again, that's why I say that we're somewhat limiting or bracketing the upside to some degree, because we're not out there doing super prospective areas, but also extremely limiting the downside because we're behind very successful operators in proven areas that make sense. So.
Well, and I thought that's what was so interesting when we were talking, is that you said, well, we're investing with companies that you've mostly heard of, that most everyday people have heard of. It's not just, some fly by night or somebody that's just trying to get started. So I think that is a source of comfort. And I think it's important because they have to have the capital to ride the ups and downs of whatever is happening in the oil and gas industry. Okay. So the time horizon for your fund is 5 to 7 years.
That's right.
Is that right? Okay. And then is there any sort of preferred return structure, distribution waterfall, or anything like that in your fund?
Yeah. So the day one investors come in, there's an 8% preferred return that's compounding annually. So again, that starts day one. And then after the 8% is returned, whatever point in time that is, there will be an 80-20 split. So 80 to the investors, 20% to management.
Okay. So pretty normal, you guys. This is that's pretty standard in funds, is the 7 to 8%, and then the 80-20 split after all of your capital has been returned and your preferred return has been returned to you. And so is there any specific way that this investment might fit into an investor's strategy that you would recommend, or is it a pure income or growth play or anything like that?
That's right. So I'd say probably a couple different things to that. First, I'll go touch maybe more on the market dynamics side of it. And then the second, I'd touch to more like, as an individual investor, how this would fit. But from the market perspective, as we talked about, we're investing alongside or behind these proven and successful operators. And so those operators, especially from a public company perspective, are obviously a lot more correlated to the markets or volatile towards what happens in the market sentiment, commodity prices, and et cetera. And so there's a lot of factors that kind of go into what we're doing. Is we're providing these same results that these guys get, except, it's not bled through all of those lenses. And so what I would say is we typically end up performing a lot better in higher commodity prices than like what a public equity stock might do. But also we're not as volatile as prices go down because, again, we're not dealing with market sentiment. And so we tend to correlate a lot better in those scenarios for an investor, again, where you're bracketing the downside, but also kind of being able to participate in the upside. And we do that predominantly through hedging. And so effectively what we're saying is we're locking in future prices on projects that we invest in. So that way we know what our returns will be on that project. We could spend a whole podcast episode, probably 2 or 3 on how we look at that. But just know that we're kind of trying to lock in as much as we can along the way. And then from an individual investor perspective, we're not a true or pure drilling fund. And so they're not maybe the same. I mean, there are the same tax deductions as what you would get in a drilling fund. So I would tell investors that, hey, if you're looking for energy exposure, I would pull out of your public equity stocks, put it into private investments, because we are getting the direct at the well returns versus, kind of through the market. Of course, that provides the tax benefits. And so typically 70% to 85% of all capital deployed is deducted year one. The remainder can be, deducted through bonus depreciation and or over time. And so you're getting those deductions right away. And we're kind of promising that 50% of your investment over those first 24 months will be deducted. So that could be a tool from a tax perspective. And then really predominantly what we're focusing on is sort of bringing a private equity type growth model to this space. And so typical drilling funds or even just kind of other funds in this space, I feel like are driving so hard tax that they're foregoing maybe some, higher returns. And so we we really don't look at returns from a tax perspective. We want good gross returns, and that will result, of course, in good net tax returns. And so if a project doesn't make sense on a whole, we're not going to invest in it just because the tax benefits might be there.
I think that's smart in life anyway. That's smart for any investment.
I understand kind of in this space that it is convenient to
fall into the whole tax
when you've got a lot of tax bill coming due. It's a great option, and we can still provide that. It's just going to come in differently. And so within that time horizon, we're investing for the first 3 years, like I mentioned. During that time frame, we should be generating a net tax loss to the investors because of the tax deductions and the capital that we're deploying. And then as things move across, year 4 on, we're making distributions. Hopefully some of those are going against your tax basis, so you're not necessarily paying taxes, but there will start to be income generated, and that's when we would exit the asset, convert all that future income from ordinary income from a taxable perspective to capital gains. And so again, really, it could be income and growth. It's predominantly growth, thinking through a private equity type approach, just saying, hey, I'm giving you more privatized access returns to these public operators and, of course, private operators from a private operator perspective that an individual investor would never have access to.
Right. And I think it's important to point out, you guys, when he's talking about, so that, if you sell your equities that you were already owning in, let's say, Chevron, you're not going to make as much on your dividends. And I mean, who knows what the stock price is doing, but because Chevron is making the same amount that Trellis is because they are a co-owner with them. And because Chevron has all of these people to pay and, tax people and everything that they need to do to be a public corporation, you're not going to get as much. Whereas Trellis is very small. You guys have a handful of employees. And so a lot of that is passed on to the investor. And so you're basically getting like direct access to the co-ownership of these wells, to the drilling. And it doesn't have as many people to, funnel through, essentially. Am I explaining that right? Do I understand?
No,
okay.
Yeah.
Okay. I just want to make sure I understand it right. Because that's one of my, I try to always just put it in a way, that you can like see it in your mind. So, and that's why I think you guys are unique. Because you are investing right alongside of Chevron, and most of the time in oil and gas, what you see is they need capital for the actual equipment. They need, you're going to buy the land to own the mineral rights. You're going to actually be, paying money so that they can drill. All of these are very, very capital intensive. And so that's normally what you see from a fund. Whereas with Trellis, it's a little bit different, whereas you are going to in like as a co-owner and you're, buying part of, you could look at it is what his explanation was as a building, but really you're co-owning part of that drilling operation.
Yep.
Yes?
Yeah. No, that's all great.
Okay.
Yeah.
All right, good. I mean, let me know if I'm messing up anything. If I should be saying something else. Okay.
No, that's perfect.
Okay, wonderful. And so one of my questions that I always ask is, do you guys, the managers, do you guys have your own capital invested in the fund also?
Yes. Yeah. So we, as of now, we've got, I guess roughly 20% of the fund is our own capital.
Okay.
And so
this is good.
I think in order to make this work, we have to sort of, because of the way that projects stack on top of each other, you're going to kind of see production sort of do this, right? Mm-hmm. And so we're kind of in that phase right now where we're starting to pile different projects into there, which requires funding up front prior to our full fundraise. And so we are funding that portion of it. And most likely that'll all stay in. And so the PPM says we're required $1 million of the 25, but it'll end up being much more than that at the end of the day.
Okay. All right. Well, that's good because one of my litmus tests for any fund is making sure that the sponsors, that your interests are aligned with the investors' interests. And I like to have the money in and not just as a loan, like sure. It's like your money is actually in the fund. So, am I missing anything? Am I missing anything huge that makes your fund stand out from the others? Because I feel like we've given kind of a brief overview of people that would be able to then ask for some more information. Again, this is open to accredited investors and the minimum is $50,000. Mm-hmm. You can use IRA money?
You can use IRA money. Of course, some of the tax benefits that we mentioned will not be applicable.
Right. So if you want the tax benefits, you obviously have to have, you need to just put in cash. But I have, there are people that want to put it in their Roth IRA because you want to grow that as big as you can by the time you're retired so that you can then have tax-free income when you go into retirement. So I also see that as a benefit too. So I do applaud what you're doing. I think that it is giving access to people, that they normally wouldn't have access to something. So, I wish you luck and I'm really glad that you were on the show.
Definitely. I appreciate you having me. This has been great.
Yeah. Well, let us know if you have any questions, you guys. I'm going to have Braden's and Trellis's information so that you can check out their website in the show notes. And you can always call me if you have any other questions, and then we can talk about your situation. So thank you so much for listening. Thank you again for being on. And let me know if you have any questions, you guys. Have a great day. Thank you for listening to the Unconventional Investor Podcast. I hope you feel more confident in how you can grow your wealth using the strategies I shared in this episode. If you're ready to take the next step in diversifying your portfolio outside the stock market with alternative investments, head to mefinancial.net/contact us to book a 15-minute consult call with me. Let's discuss how we can work together to achieve your financial goals. Until then, I'll see you on the next episode.